Before we begin, a quick and important disclaimer. I am not a certified financial advisor, and this presentation is for educational and informational purposes only. Buying a home and securing a mortgage is one of the biggest financial decisions you will ever make. Your personal situation is unique, so please consult with a qualified, licensed professional before making any financial commitments. The average American with a 30-year mortgage will pay over $280,000 in interest alone. Let that sink in. Not the loan, not the house, just the interest. For millions of people, that's more than the original price of the home they bought. It's a staggering number. It's a second invisible house that you buy for the bank, paid for over 30 years of your life. And the most frustrating part? The system is designed to be a confusing, impenetrable maze of jargon and complex math. You see words like principal, interest, escrow, amortization, PMI, and your eyes glaze over. You make your payment every single month for years, and you look at your statement only to see the loan balance has barely budged. It feels like you're running on a financial treadmill, working harder and harder but going nowhere. Can feel like a trap. Well, today we're breaking out of that trap. This is not going to be another boring finance lecture. This is your blueprint, your step-by-step guide to understanding the most powerful and misunderstood financial tool in America, the mortgage. We are going to demystify this entire process. We are going to strip away the jargon, throw out the confusing formulas, and explain in plain, simple English how every single dollar of your mortgage works. By the end of this, you will understand exactly how the banks make their money, how your payments are calculated, and most importantly, how you can navigate this system to save yourself tens or even hundreds of thousands of dollars over the life of your loan. This is the financial education you never got in school, and it's going to change the way you think about homeownership forever. To truly understand a mortgage, you don't need a degree in economics. You just need to understand three core pillars. Everything, and I mean everything, comes back to these three things: the principal, the interest, and time. That's it. Principal, interest, and time. Let's break down the first one. The principal. This is the simplest piece of the puzzle. The principal is the total amount of money you borrow from the lender. It's the sticker price of the house, minus your down payment. Let's use a really easy example that we'll stick with. Imagine you want to buy a house that costs $400,000. The bank isn't just going to hand you that money with nothing from you. They want you to have some skin in the game. That's your down payment. For decades, the magic number you've always heard is a 20% down payment. Why 20%? Because from the bank's perspective, it's all about risk. If you put down a significant chunk of your own money, you are far less likely to just walk away from the house if times get tough. You've got something to lose. A 20% down payment on our $400,000 house is $80,000. So, you give the bank $80,000 of your own cash. The bank then gives you the rest. $400,000 minus your $80,000 down payment leaves $320,000. That $320,000 is your principal. It's the starting line. It's the mountain of debt you now have to climb. Simple enough, right? That's pillar one. Now for pillar two, the interest. This is where things get interesting, and it's where the bank makes its fortune. If the principal is the money you borrow, the interest is the fee you pay for the privilege of borrowing it. Think of it like this: you are renting money from the bank. The $320,000 principal is the giant pile of cash you're renting. The interest is the rental fee you pay every single month for 30 years straight. This fee is expressed as a percentage, the interest rate. You've seen it everywhere. Rates are at 6%. Rates just hit 7%. That percentage is the single most powerful, most impactful number in your entire financial life. A single percentage point difference on our $320,000 loan can mean the difference of over $70,000 in total payments. That one little number dictates whether you'll be paying off your house for 25 years or 30 years, whether you can afford family vacations, or whether you'll be working an extra 5 years before you can retire. It's that important. So, where does this rate come from? It's determined by a few key factors: the overall economy, your credit score, which is basically your financial report card, the type of loan you get, and the size of your down payment. The better your financial health, the lower the risk you are to the bank, and the lower the interest rate they will offer you. A lower rate means a lower monthly rental fee on that money. But here's the secret, the part that's designed to confuse you. Your monthly payment isn't split evenly between paying back the loan and paying the bank's fee. Oh no. The bank has a secret weapon to make sure they get their money first. And that weapon is called amortization. Amortization. It sounds like a complicated, scary word, but the concept is brutally simple. It is the schedule that determines how much of your monthly payment goes towards interest and how much goes towards your principal. And here is the gut punch. For the first several years of your mortgage, your payment is almost entirely interest. Let's go back to our $320,000 loan. Let's say you get a 7% interest rate. Your monthly payment for principal and interest would be about $2,128. You pay that on month 1 feeling proud. You've just put over $2,000 towards your house. But then you look at the statement. Out of that $2,128, a whopping $1,866 went straight to the bank as interest. Only $262, a tiny fraction, actually went to reducing your $320,000 loan. You just made a massive payment, and your debt only went down by the cost of a nice dinner out. Month after month, year after year, it's the same story. You are shoveling money at the bank, and most of it is just their profit. It's a front-loaded system. The bank collects the majority of its profit in the first decade of your loan. Why? Because that's when you're the riskiest. They want to get paid back as quickly as possible just in case you default down the road. It's like trying to fill a bucket with a hole in it. For the first 10 years, you're pouring in thousands of dollars, but most of it is leaking right out as interest payments going directly into the bank's pockets. This is why your loan balance seems to move at a glacial pace in the beginning. It's not your imagination. The game is rigged for you to be paying interest, not your loan. So we have the principal, the amount of the loan. We have the interest, the cost of the loan. And we have amortization, the bank system for getting paid first. But there's one more pillar, the one that makes all of this possible for the banks. The one that turns a small percentage into a mountain of profit. That third and most deceptive element is time. Time is the invisible ink in the mortgage contract. It's the silent partner working for the bank 24 hours a day for 30 years straight. It's what takes a reasonable sounding interest rate, like 5 or 6%, and quietly magnifies it into a fortune. And it does this using the powerful and frankly brutal mechanics of that amortization schedule we talked about. Let's make this real. Imagine you just signed the papers for your dream home. You borrowed $400,000. Your interest rate is 6%, and your term is 30 years. Your monthly payment for principal and interest comes out to about $2,400. You make that first payment. You feel a sense of pride. You're a homeowner. You're building equity. You're living the American dream. But then your first statement arrives. You look at the breakdown of that $2,400 payment, and your heart sinks. You see that of the money you just sent, only $401 went towards your loan balance. Only $400 actually went to paying for your house. The other $1,999? That was interest. That was the bank's profit. It was, in essence, rent you paid for the privilege of borrowing their money for 1 month. And you have to do this 359 more times. This isn't an accident. It's the design. It's called being front-loaded. The entire system is engineered to ensure the bank gets its profit first. All of it. For the first several years of your mortgage, you are doing little more than renting money from the bank. Your payments are almost entirely interest. Think of your mortgage not as a straight line, but as a giant lopsided mountain you have to climb. The peak of the mountain is paying off your loan. For the first 10 to 15 years, you're climbing the steepest, most grueling part of the face. You're putting in all this effort making payment after payment, but when you look down, you've barely made any vertical progress. You're just inching your way up the principal balance while paying thousands upon thousands in interest. Let's look at our $400,000 loan example. After 5 full years of making payments, that's 60 payments totaling $144,000 out of your pocket. How much of your loan do you think you've paid off? You've paid the bank nearly $150,000, but your loan balance has only gone down by about $27,000. You still owe over $372,000. Over $116,000 of your hard-earned dollars vanished into thin air, straight into the bank's profit column. After 10 years, a full decade of your life, 120 payments, $288,000 paid. You've only managed to chip away $62,000 from the principal. You still owe the bank nearly $338,000 on your original $400,000 loan. Meanwhile, you've handed them over $225,000 in pure interest. It's only after about year 17 or 18 that you finally reach what's called the tipping point. This is the moment where, for the first time, more of your monthly payment is going towards your principal than towards interest. For 17 years, the bank has paid itself first. For 17 years, your primary financial goal was not building your own wealth, but building theirs. This structure is a work of genius from the bank's perspective. It's all about minimizing their risk. Think about it. When is a homeowner most likely to default on their loan? It's usually in the earlier years when life happens, a job loss, a medical emergency, a divorce. The bank knows this. So, by front-loading the interest, they ensure that even if you default in year 7, they've already collected a massive amount of pure profit from you. They haven't just been covering their costs, they've been making a killing. Then they can foreclose on the property, take the house back, which still has most of its value, and sell it to someone else, starting the whole incredibly profitable process all over again. They literally cannot lose. It is a system designed for them to win whether you succeed or fail. This creates a dangerous illusion of ownership. For the first decade, you are functionally a renter who is also responsible for all the repairs. You pay the property taxes. You fix the leaky roof. You replace the broken water heater. You do all the work and shoulder all the costs of ownership, but the bank is reaping all the financial rewards. You hold all the risk, they hold all the power and the majority of the equity. You have financial handcuffs on, and the key is sitting in a vault at the bank on a timer set for 30 years. So that's the trap. A 30-year timeline combined with the front-loaded amortization schedule creates a system where you spend the first half of your loan's life primarily enriching the lender, not yourself. It's a slow, methodical transfer of wealth from your pocket to theirs, sanctioned by law and accepted as just the way things are. But what if it doesn't have to be that way? What if the 30-year sentence wasn't mandatory? What if you could fundamentally break the bank's model and force their system to work for you, not against you? The truth is, buried in the dense legal language of most standard mortgage agreements in the United States is a clause, a key. It's a provision that gives you, the borrower, an incredible amount of power the banks hope you never learn how to use. This clause allows you to bypass their entire front-loaded profit scheme. It allows you to skip the long, grueling climb up the interest mountain and go straight for the principal. You can, in effect, rewrite the rules of your own loan. You can decide how quickly you pay it off, and in doing so, you can decide how much profit the bank actually gets to make from you. We're not talking about refinancing or complex financial maneuvers. We're talking about a simple, powerful strategy that anyone can use, starting with their very next payment. It's a strategy that can save you tens or even hundreds of thousands of dollars in interest and shave years, even a decade or more, off your loan. It's time to stop playing their game. It's time to learn the rules they don't talk about. Because the moment you understand how to make a principal-only payment, the entire balance of power shifts. So how do you do it? How do you make a payment that goes directly to the heart of your loan, bypassing the massive wall of interest that eats up your monthly check? You do it by making a principal-only payment. And it is, without a doubt, the single most powerful tool a homeowner has. To understand why it's so effective, you have to visualize your mortgage differently. Stop thinking of it as one big number. Instead, imagine it's a giant beast. The principal, the $400,000 you actually borrowed, is the body of the beast. The interest is its enormous, regenerating shield. Every single month, when you make your regular payment, the vast majority of your money just clangs off that shield. The bank takes its interest payment first. Only the tiny amount left over, a few $100s, gets through to land a small blow on the beast itself. And because the beast is still so large, the next month, the shield of interest grows back just as thick. It's a brutal, demoralizing cycle. That is the game. Principal-only payment is different. It's like a secret weapon, an armor-piercing round. Completely ignores the shield. Every single dollar of a principal-only payment flies straight past the interest and strikes the beast directly. It's a direct hit every time. And here's the beautiful part. When you wound the beast, when you shrink the principal, the shield it generates next month is a little bit smaller. The interest that accrues is calculated on a lower balance. So your next regular payment will have a slightly easier time, with a tiny bit more of it getting through to the principal. You are not just paying down your loan faster. You are actively weakening the bank's ability to charge you interest for the rest of your life. You are breaking the cycle. Now for the critical part, how to actually do it. Because if you're not careful, the bank will simply take your extra money and do one of two things you don't want. They might just hold it and apply it to your next month's payment, which does absolutely nothing to reduce your principal. Or they might apply it as a generic prepayment, which sounds good, but often doesn't get processed correctly to attack the principal immediately. You have to be specific. You have to be deliberate. There are 3 primary ways to ensure your money does what you tell it to do. First, the easiest method, your lender's online portal. Log into your mortgage account online. When you go to make a payment, look very carefully. Don't just hit pay bill. Look for options like make a payment, additional payments, or one-time payment. On that screen, you should see your regular monthly amount due. But somewhere nearby, there is often a separate box. It might be labeled additional principal, principal curtailment, or extra to principal. This is your target. You pay your regular monthly amount, and then you put your extra money, whether it's $50 or $500, into this specific box. This tells their system exactly where to send it. It's a direct order. Second, the old school method, writing a physical check. If you mail in your payments, or even if you pay online but want a paper trail, this is for you. You will write 2 separate checks. The first check is for your normal monthly payment amount. Nothing special there. The second check is for the extra amount you want to send. Let's say it's $100. In the memo line of that second check, you must write the magic words. For principal only. Do not write anything else. Not extra payment. Not for mortgage. You write, for principal only. By law, when a check is designated this way for a secured loan, the lender must apply it as you've instructed. It's a legally binding instruction you're writing on that check. Third, the direct approach, call them. Pick up the phone, call the customer service number for your mortgage servicer, and tell the representative, I would like to make an additional payment to be applied to principal only. They will know exactly what you mean. Stay on the line while they process it, and ask for a confirmation number or email. This creates a verbal record of your intent. Whichever method you choose, there is one final crucial step: verification. You must check your next mortgage statement. Don't just assume they did it right. Look at your statement. You should see your regular payment applied. And then you should see a separate line item that explicitly says principal curtailment or payment to principal, with the exact extra amount you sent. You should also see that the total principal balance of your loan has dropped by that amount, plus the small portion of principal from your regular payment. If you don't see this, you call them immediately and ask why your specific instructions were not followed. You are the customer. That is your money. You are in charge. Now you might be thinking, this sounds like a lot of work for a small amount of money. Does an extra $100 a month really make a difference on a massive loan? Let's run the numbers. Let's say you have a new $400,000 30-year mortgage at a 6.5% interest rate. Your standard principal and interest payment is about $2,528. If you just make that payment every month for 30 years, you will pay the bank over $509,000 in interest alone. You will pay more in interest than you originally borrowed for the house. That is the bank's perfect scenario. But now you use your new weapon. From the very first month, you decide to send in just $100 extra specifically designated for principal. It's the cost of a few fancy coffees and a streaming subscription. A tiny sacrifice. What happens? By sending that extra $100 a month, you will pay off your entire mortgage 4 years and 2 months early. But that's not the real prize. The real prize is the interest you never have to pay. In this scenario, you would save over $88,000. $88,000 that stays in your pocket, not the bank's. All for the price of $100 a month. Imagine if you could send $200 or $500. We're talking about 6-figure savings and potentially a decade of your life reclaimed from debt. This isn't a trick. It's not a loophole. It's just math. It's understanding the system that was built to work against you and using its own rules to your advantage. Every dollar of principal you eliminate is a dollar the bank can never charge you interest on again for the entire life of the loan. The most common pushback I hear is, but I don't have extra money, and I understand that. But this is about a shift in mindset. It's not about finding hundreds of extra dollars. It's about recognizing that even $25 sent to principal is infinitely more powerful than zero. It's about taking any small windfall, a $50 birthday check, a $200 bonus from work, the money you get from selling something on Facebook Marketplace, and instead of letting it vanish into daily expenses, you make a conscious choice. You fire it like a bullet straight at your mortgage principal. You choose to pay your future self first. The other question is, shouldn't I invest that money instead? I might get a better return in the stock market. It's a valid question, but think of it this way. Paying down your mortgage is a guaranteed, tax-free, risk-free return on your money equal to your interest rate. If your rate is 6.5%, you are getting a guaranteed 6.5% return. The stock market might give you 10%, or it might lose you 20%. For the peace of mind that comes with owning your home free and clear, this guaranteed return is one of the smartest, safest investments you can ever make. You've now learned how to attack the principle, the body of the beast. You know how to shrink it, month by month, weakening it over time. But what if I told you there was a way to not just shrink the beast, but to permanently weaken the shield it uses to protect itself? A way to fundamentally lower the interest rate it feeds on? Most people immediately think of refinancing. And that's a powerful tool, but it's also expensive, time-consuming, and comes with thousands of dollars in closing costs. But almost no one knows about its secret, much cheaper cousin, the mortgage recast. Understanding the profound difference between these two strategies is the next level of taking control. And knowing which one to use and when can save you a fortune, not just in interest but in fees you should never have to pay. So let's put this into a real-world scenario. Imagine two neighbors, Sarah and Mike. They bought similar houses at the same time, with identical 30-year fixed-rate mortgages for $400,000 at a 6.5% interest rate. Their monthly principal and interest payment is about $2,528. 5 years go by. They've both been diligently making payments. Now a stroke of luck hits both of them. They each receive an unexpected inheritance of $50,000. This is the fork in the road. This is where one decision can save tens of thousands of dollars and immense stress, while the other can be a costly, bureaucratic nightmare. Sarah looks at her situation. Interest rates have dropped since she bought her house. The going rate is now 5.5%. She thinks, this is perfect. I'll use this $50,000 to refinance my loan. I'll get a lower interest rate, a lower monthly payment, and I'll be in a much better financial position. Sounds like a slam dunk. So she calls a mortgage broker. And the entire process starts over, almost exactly like when she first bought the house. She has to fill out a mountain of paperwork, providing bank statements, tax returns, and pay stubs. The lender runs a hard inquiry on her credit, which temporarily dings her score. They require a new appraisal on her home to make sure it's still worth what she owes, which costs her about $500 out of pocket. She has to go through the entire underwriting process again, where a team of people scrutinizes every single aspect of her financial life. After weeks of back and forth, she's finally approved. But then come the closing costs. Just like when she bought the house, she has to pay for things like loan origination fees, title insurance, and other administrative charges. These costs add up to about 2% of the new loan amount, roughly $7,000. She decides to roll these costs into the new loan. So let's do the math. Her original loan was $400,000. After 5 years, she's paid it down to about $370,000. She wanted to use her $50,000 inheritance to pay it down further, but a chunk of it gets eaten by the process. Let's say she uses her full inheritance to pay down the principal before the refinance. Her new loan balance would be $320,000. But then she has to add back the $7,000 in closing costs. So her new loan is for $327,000. The good news is she gets that lower 5.5% interest rate. Her new monthly principal and interest payment on a fresh 30-year mortgage is now about $1,857. That's a savings of nearly $670 a month. On the surface, this looks like a massive win. But here's the hidden trap. Sarah was already 5 years into her original mortgage. By refinancing into a new 30-year loan, she just reset the clock. She is now facing 30 more years of payments. In total, she will be paying on her house for 35 years. The interest amortization schedule starts all over again, meaning the first several years of her new loan will once again be almost entirely interest payments. She's back on the slow-moving part of the interest treadmill. Now let's look at her neighbor, Mike. He gets the same $50,000. He knows interest rates have dropped, but he dreads the idea of going through the entire mortgage application process again. He doesn't want another credit check, doesn't want to pay for an appraisal, and definitely doesn't want to pay thousands in closing costs. He remembers a little-known strategy called a mortgage recast. So Mike makes one phone call. He calls the company he already sends his mortgage check to every month, his current loan servicer. He says, "I'd like to make a $50,000 lump sum payment directly to my principal, and I would like to request a mortgage recast." The person on the other end of the line knows exactly what he's talking about. They say, "Certainly. There's a one-time administrative fee of $250. Once your $50,000 payment clears, we will re-amortize your remaining loan balance over your remaining term." That's it. No credit check. No new application. No appraisal. No thousands of dollars in closing costs. Let's look at Mike's math. His loan balance was also $370,000. He applies the full $50,000 to the principal. His new loan balance is now $320,000. The key difference is what happens next. The bank doesn't change his interest rate. It's still 6.5%. And they don't change his loan term. He still has 25 years left to pay. What they do is recalculate his monthly payment based on the new, lower balance spread out over the remaining 25 years. His new monthly principal and interest payment is now $2,138. That's a savings of about $390 a month. It's not as much monthly savings as Sarah got, but Mike avoided the entire soul-crushing refinance process, saved $6,750 in closing costs and fees, and most importantly, he did not reset the clock on his mortgage. He's still on track to own his home free and clear in 25 years, a full 5 years before Sarah will. Over the life of the loan, Mike's decision to recast instead of refinance, even at a higher interest rate, will save him a fortune in total interest paid, simply because he's paying for 5 fewer years. So, when does each strategy make sense? Refinancing is a powerful tool, but it's for a specific purpose: to change the fundamental terms of your loan, primarily the interest rate. You should only consider refinancing if current market rates are significantly lower than your current rate, usually at least a full percentage point, so that the interest savings will quickly outweigh the thousands of dollars in closing costs. It's a brand new loan to replace your old one. A mortgage recast, on the other hand, is not a new loan. It's a modification of your existing payment schedule. It's the perfect tool for when you come into a large sum of money, an inheritance, a work bonus, the sale of another property, and your primary goal is to lower your monthly payment obligation without the expense and hassle of a refinance. You keep your same loan, your same interest rate, and your same payoff date. You simply re-amortize the smaller balance. The crucial takeaway is this: refinancing attacks the interest rate. Recasting attacks the principal balance. Many people like Sarah mistakenly use refinancing as a tool to lower their payment after a windfall, and in doing so they not only pay thousands in unnecessary fees but they trap themselves in debt for years, sometimes decades longer. Mike understood the goal. His goal wasn't a new rate. It was a lower payment on the loan he already had. He used the right tool for the job. Now, it's important to know that not all loans are eligible for recasting. Most conventional loans are, but FHA and VA loans typically are not. And you have to ask for it. Banks don't advertise this service because frankly it's not a big moneymaker for them. They'd much rather you pay them thousands to refinance. But now you know the difference. You have the knowledge to control the conversation. Understanding how to manage your loan with tools like recasting is a massive step. But your monthly mortgage payment isn't just made up of principal and interest. There are two other ghost-like components that are often misunderstood, yet have the power to make your payment jump up unexpectedly, even on a fixed-rate mortgage. They are the silent partners in your homeownership journey: property taxes and homeowners insurance, and the way your lender manages them, through a special account called an escrow account, is one of the most confusing and frustrating parts of a mortgage for millions of Americans. Untangling how that account really works is the key to never being surprised by a sudden payment increase again. So let's pull back the curtain on this thing called escrow. Imagine you have a special savings account but you don't control it. Your mortgage lender does. Every single month when you make your mortgage payment, a piece of that money doesn't go towards your loan at all. Instead, your lender schemes it off the top and deposits it into this savings account, your escrow account. They do this all year long, and the account's sole purpose is to save up enough money to pay two massive bills on your behalf: your annual property taxes and your yearly homeowner's insurance premium. Think of it like this: your lender is your very strict, financially responsible roommate. They know you have to pay the big utility bills, taxes, and insurance, but they don't trust you to save up for them on your own. So, they take a little bit of money from you every month and put it in a jar so when those huge bills come due, the money is already there waiting. It's a forced savings plan. Now, why would they do this? It sounds a little controlling, right? Well, it is. But it's for a very specific, self-serving reason. Your lender has a colossal financial interest in your home. They've loaned you hundreds of thousands of dollars, and the house itself is the collateral. It's their insurance policy. If you stop paying your property taxes, the county or city government can put a lien on your house and eventually seize it and sell it at auction to get their money. If that happens, the lender's investment, your mortgage, is wiped out. They get nothing. Similarly, if your house burns to the ground and you foolishly let your homeowner's insurance lapse, their collateral, the very thing securing that massive loan, is now a pile of ashes. It's worthless. The lender has just lost a fortune. So the escrow account isn't really a service for you. It's a protection mechanism for the lender. By controlling the payment of your taxes and insurance, they guarantee that their investment is safe from both the taxman and a natural disaster. So how do they figure out how much to take from you each month? It's actually pretty simple math. At the beginning of the year, they estimate your total property tax bill for the next 12 months. Let's say they estimate it'll be $3,600. Then, they estimate your homeowner's insurance premium for the year. Let's say that's $1,200. They add those two numbers together. $3,600 plus $1,200 is $4,800. That is your total estimated annual escrow expense. To get your monthly escrow payment, they just divide that by 12. 4,800 divided by 12 is $400 per month. So, in this example, $400 of your total mortgage payment each month is diverted into that escrow account. Just sits there accumulating. When the semi-annual property tax bill comes due, the lender pays it for you, directly from your escrow account. When the homeowner's insurance premium is due, same thing, they pay it directly. You never have to worry about saving for these bills yourself. But here's where the first bit of confusion comes in. The law actually allows the lender to keep a little extra money in that account. It's called an escrow cushion. They're allowed to keep a buffer equal to about 2 months' worth of your escrow payments. In our example, that would be an $800 cushion. This is to protect them in case the tax or insurance bills come in slightly higher than they estimated. It's a safety net. This all sounds fine in theory, but the system has a major flaw. It runs on estimates. And estimates are often wrong. This is where the dreaded escrow analysis comes in. And it's the reason your payment can suddenly skyrocket, even on a fixed-rate mortgage. Once a year, your lender is required by law to perform this analysis. They look at 3 things. First, how much they predicted your taxes and insurance would be for the past year. Second, how much those bills actually were. And third, how much you've paid into the account. Then they compare. This comparison can only have one of 3 outcomes, and one of them is the one that causes all the pain. Let's start with the happy outcome. A surplus. This happens when your property taxes or your insurance premium, or both, ended up being less than what the lender estimated. Maybe you shopped around and found a cheaper insurance policy. Congratulations, you overpaid into your escrow account all year. The lender looks at the account, sees the extra cash, and if it's over $50, they are legally required to cut you a check and mail it to you. Feels like free money. And even better, they'll recalculate your monthly payment for the upcoming year based on these new lower costs, so your mortgage payment will actually go down. This is the best case scenario. The second outcome is that they were spot on. Their estimates were perfect, everything is balanced, and your payment stays exactly the same. This is incredibly rare. The third outcome is the one that sends homeowners into a panic. A shortage. This is when your property taxes or your insurance premium, or both, came in higher than the lender's initial estimate. And this is extremely common. Property values go up, so the county raises your tax assessment. Insurance companies raise their rates to cover inflation or increased risk in your area. Suddenly, the money you've been paying into your escrow account all year isn't enough to cover the actual bills. Let's go back to our example. The lender estimated your total annual cost at $4,800, so you paid $400 a month. But at the end of the year, they do the analysis and find out your property taxes actually went up to $4,200, and your insurance premium rose to $1,320. Your actual total cost for the year was $5,520, but you only paid in $4,800. That means you have a $720 shortage. The lender doesn't just eat this cost. They paid the bills for you, so you owe them that $720 back. This is where the payment shock happens. The lender will now recalculate your monthly payment for the next year. And they do it with a brutal 1-2 punch. First, they have to adjust your payment for the new reality. Your costs are now $5,520 a year. Divide that by 12, and your new base escrow payment is now $460 a month. That's a $60 increase right there, just to keep you from having another shortage next year. But that's not all. You still owe them for the $720 shortage from last year. They will typically spread that payback over the next 12 months. So they take that $720 shortage, divide it by 12, and that adds another $60 to your monthly payment. So your new monthly escrow payment is the $460 for the upcoming year's estimated costs, plus the $60 to pay back last year's shortage. Your total escrow payment has jumped from $400 a month to $520 a month. That's a $120 increase in your total mortgage payment overnight. You didn't refinance, you didn't miss a payment, your interest rate didn't change, but your payment just exploded. This is the moment millions of Americans open a letter from their mortgage company and their heart sinks. The worst part is you feel powerless. You can't stop the county from reassessing your home's value and raising your taxes. But you aren't completely helpless. You can take control of one part of the equation: your homeowner's insurance. Every single year, you should shop around for new insurance quotes. Loyalty to an insurance company rarely pays off. A few phone calls could save you hundreds of dollars a year, which will directly lower your escrow payment. You can also look into appealing your property tax assessment if you have legitimate grounds to believe your home is overvalued by the county. Ultimately, understanding escrow means understanding that your fixed-rate mortgage payment isn't really fixed. The principal and interest, the P and I of your pity payment, are locked in. But the T and I, the taxes and insurance, are wild cards that are almost guaranteed to change over time. So while your escrow payment can fluctuate, that core part of the loan, the principal and interest payment that you agreed to on closing day, that part is supposed to be your rock. It should be solid and predictable for 30 years. Right? Well, that depends entirely on the type of loan you choose, which can be the single biggest financial decision you ever make. And we're going to break that down next. Think of the world of mortgages as being split into two giant rival families. The first family is old school, dependable, and maybe a little boring. The second is flashy, exciting, and carries a hint of danger. Your choice of which family to align with will define the next few decades of your financial life. Let's meet the first family: the fixed-rate mortgages. This is the bedrock of American homeownership. The concept is beautifully simple. The interest rate you get on day one is the exact same interest rate you will have on day 10,950. It is locked. It is fixed. It doesn't matter if the economy goes crazy, if inflation skyrockets, or if the stock market is a roller coaster. Your rate will never ever change. This means your monthly payment for principal and interest will be the exact same amount for the entire life of the loan. It's the ultimate in predictability. It's the Toyota Camry of loans. It's not going to turn any heads, but you know it's going to start every single morning and get you where you need to go without any drama. Within this family, there are two famous siblings: the 30-year fixed and the 15-year fixed. The 30-year fixed is the undisputed king. It's the loan your parents probably had. It's the one you see in movies. It's the American standard. Its superpower is its low monthly payment. By stretching the loan out over 3 decades, you get the most affordable payment possible, which allows more people to qualify for a larger loan and buy the house they want. But this affordability comes at a staggering cost. A cost that is hidden in plain sight. Let's do some quick, terrifying math. Imagine you get a $400,000 loan at a 6% interest rate for 30 years. Your monthly principal and interest payment would be about $2,400. Sounds manageable, right? But over those 30 years, you will pay the bank a total of over $863,000. That means you paid more than $463,000 in interest alone. You paid more in interest than the original price of the loan. You essentially bought your house and then you bought another one just for the bank. That is the brutal trade-off of the 30-year fixed mortgage. Now let's look at its ambitious, financially savvy younger sibling: the 15-year fixed. The 15-year mortgage is for people who hate debt. The concept is the same, the rate is fixed, but you're paying it off in half the time. This means your monthly payment is going to be significantly higher. Using that same $400,000 loan at a slightly better 5.5% rate, you often get a better rate for shorter terms. Your monthly payment would jump to about $3,260. That's over $800 more per month, a serious chunk of change. Many people look at that payment and immediately say, "No way." But they're missing the magic. Over those 15 years, you'd pay a total of about $587,000. Your total interest paid? Around $187,000. Compare that to the $463,000 in interest on the 30-year loan. By choosing the 15-year mortgage, you would save over $250,000. $276,000 to be exact. On top of that, you own your home free and clear in 15 years while your neighbor is still just hitting the halfway point. You're building wealth at lightning speed. It's a path of short-term sacrifice for massive long-term gain. So that's the first family. Steady, predictable, with a choice between long-term affordability and long-term wealth building. Now let's meet the other family. The wild ones. The adjustable rate mortgages or ARMs. If the fixed rate is a reliable sedan, the ARM is a sleek Italian sports car. It's thrilling at first, but it can be unpredictable and dangerous if you don't know how to handle it. An ARM lures you in with a low introductory interest rate, a teaser rate, that's often significantly lower than what you'd get on a fixed-rate loan. This rate is fixed for an initial period, typically 3, 5, 7, or 10 years. This is what the numbers in an ARM's name mean. A 5-to-1 ARM, for example, means your rate is fixed for the first 5 years. After that, the adjustable part kicks in. The /1 means the rate can change every 1 year for the rest of the loan's term, based on a specific financial index plus a margin. Your rate could go up, or it could go down. You are essentially betting on the future of interest rates. In the years leading up to the 2008 financial crisis, these loans were handed out like candy. People were drawn to the super low initial payments, allowing them to buy more house than they could actually afford. But when those initial fixed periods ended, their rates skyrocketed, their payments ballooned, and millions of people found themselves unable to pay, leading to a wave of foreclosures that crashed the global economy. Now, regulations are much tighter, but the risk is still there. So who on earth would take an ARM? They can be a powerful tool for the right person in the right situation. For instance, if you are absolutely certain you are going to sell the house before the initial fixed period is over. Maybe you're in a medical residency or on a 5-year work contract in a new city. An ARM could save you thousands in interest during the time you live there. Or, if you're a high-income earner who can easily afford the highest possible payment the loan could adjust to, you might take the gamble to save money up front. But for the average homebuyer looking for stability, an ARM is like playing with fire. Okay, so you've been introduced to the two main families, fixed and adjustable. But there's another layer to this, like a secret society that operates behind the scenes. It's not just about the type of loan, it's about the program, who is insuring it. This determines the rules of the game. First, you have conventional loans. These are the loans that are not insured or guaranteed by the federal government. They are the bread and butter of the mortgage world. Because there's no government backing, lenders are taking on all the risk themselves. Therefore, they have stricter requirements. You typically need a higher credit score, think 620 at the absolute minimum, but realistically you'll want to be much higher to get a good rate. This is also where the famous 20% down payment rule comes from. If you put down less than 20% on a conventional loan, the lender will force you to pay for private mortgage insurance or PMI. This is an extra monthly fee that protects the lender, not you, in case you default. It's basically you paying for an insurance policy for your bank. Once you reach 20% equity in your home, you can request to have that PMI removed. But what if you don't have a 740 credit score and a huge pile of cash for a 20% down payment? That's where the government steps in with a handful of special programs. The government isn't lending you the money directly. Instead, they are co-signing for you. They're telling the bank, hey, if this person can't pay, we've got your back. This makes lenders feel much safer, so they relax the rules. The most popular of these is the FHA loan, backed by the Federal Housing Administration. FHA loans are designed for first-time homebuyers and those with less than perfect credit. You can get an FHA loan with a credit score as low as 580 and a down payment of just 3.5%. This is a game changer that opens the door to homeownership for millions of Americans. But of course there's a catch. And it's a big one. FHA loans require you to pay a mortgage insurance premium, or MIP. It's similar to PMI, but with one crucial, costly difference. For most FHA loans today, you pay that MIP for the entire life of the loan. It never goes away unless you refinance into a conventional loan later. It's a permanent addition to your monthly payment. Next up is one of the best loan products in existence, but it's only for a select group, the VA loan. Guaranteed by the Department of Veterans Affairs, this loan is an incredible benefit for qualified veterans, active duty service members, and some surviving spouses. The headline feature? 0% down payment. You can buy a home with literally no money down. On top of that, VA loans have no monthly mortgage insurance. This is a powerful, well-earned benefit that can save service members tens of thousands of dollars. Finally, there's the underdog, the USDA loan. Backed by the U.S., Department of Agriculture. This loan is designed to encourage development in rural and some suburban areas. Like the VA loan, it allows for a 0% down payment. You don't have to be a farmer to get one, but the property has to be located in an eligible area. And you'd be surprised how many suburban towns qualify. There are income limits, so it's targeted at low to moderate income households. So you see, it's a two-part decision. First, you choose your family, the stability of a fixed rate or the risk of an ARM. Then you choose your program, the high requirements of a conventional loan or the accessibility of a government-backed program like FHA, VA, or USDA. A 30-year fixed FHA loan is a completely different beast than a 15-year fixed conventional loan. Each combination has its own rules, its own costs, and its own ideal customer. Understanding these options is like knowing the layout of the battlefield. But knowing the terrain is one thing. Actually going to war and securing the best possible terms for yourself is something else entirely. Now that you know what you're shopping for, how do you actually get a lender to say yes? And more importantly, how do you get them to give you a great deal instead of ripping you off? That process is called pre-approval, and it's where your journey truly begins. Think of the pre-approval process as the job interview for your money. You're not just asking for a loan. You're convincing a financial institution that you are a reliable, trustworthy, and safe bet. And just like any important interview, preparation is everything. Now, you might have heard another term thrown around, pre-qualification. It's crucial you understand the difference because one is a paper sword and the other is a steel blade. A pre-qualification is a quick, 5-minute conversation. You tell a lender your income, you estimate your debts, and they give you a rough ballpark of what you might be able to borrow. It's based on unverified information. It's a guess. It's practically worthless when it comes time to make an offer on a house. A pre-approval, on the other hand, is the real deal. This is where the lender stops taking your word for it and says, "Show me the proof." You'll submit a formal application and provide a mountain of paperwork to back up every claim you've made about your financial life. The lender will pull your official credit report, verify your income, scrutinize your bank accounts, and then after all that, issue a conditional commitment in writing for a specific loan amount. Why go through all this trouble before you've even found a house? 3 critical reasons. First, it tells you your actual budget. Don't be the person who falls in love with a $700,000 dream home, only to find out you can only get approved for $500,000. That's a special kind of heartbreak. The pre-approval letter is your financial reality check. It's your price tag. Second, it makes you a serious buyer. When you submit an offer on a home, sellers want to know you can actually close the deal. An offer from someone with a pre-approval letter from a reputable lender is infinitely more powerful than an offer from someone who just thinks they can get a loan. In a competitive market, not having a pre-approval letter is like showing up to a sword fight with a stick. You won't even be taken seriously. And third, it dramatically speeds up the closing process later on. Since the lender has already done most of the heavy lifting on your finances, they can focus on the property itself once you find it. So how do you do it? How do you get this golden ticket? It's a 4-step process. Gathering your documents, shopping for a lender, submitting the application, and surviving the underwriter. Let's start with the paperwork. I call this the financial scavenger hunt. You're going to need to assemble a folder, either physical or digital, with some key documents. First, proof of income. The lender wants to know that money is consistently flowing into your accounts. This means you'll need your most recent pay stubs, usually for the last 30 days. You'll also need your W-2 forms from the last 2 years. If you're self-employed or have a side hustle, get ready for more work. Lenders see you as a higher risk, so they'll want to see your last 2 years of complete tax returns, including all schedules, to verify your business income is stable. Next, proof of assets. This is where you prove you have the cash for the down payment and closing costs. You'll need bank statements for all of your checking and savings accounts, usually for the last 2 months. Be prepared for the lender to scrutinize these. A large, random deposit of $20,000 from your cousin last week is a huge red flag. They need to see that the money is seasoned, that it's been yours for a while. If you received a gift for the down payment, there's a formal process for that, involving a gift letter and documentation, which we'll cover later. You'll also need statements from any investment or retirement accounts, like a 401k or an IRA. Then you need your debt information. The lender needs to calculate your debt-to-income ratio, which we talked about before. This means providing information on your car loans, student loans, and credit card debt. They'll pull your credit report, of course, but having the statements ready can help clarify things. Finally, you'll need your personal identification, a copy of your driver's license and your social security number. Once you have your document dragon slain and your treasure hoard of paperwork assembled, it's time to choose a lender. And this is the single most important piece of advice I can give you. Do not just go to one place. Getting a mortgage isn't like buying a carton of milk where the price is the same everywhere. Rates, fees, and terms can vary dramatically from one lender to another. A 0.25% difference in your interest rate might not sound like much, but over 30 years, it can cost you tens of thousands of dollars. You should get pre-approval quotes from at least 3 to 5 different types of lenders. Talk to your local bank or credit union, sure, but also talk to a mortgage broker. They're like a travel agent for loans, who can shop your application to dozens of wholesale lenders to find the best deal. And don't forget online lenders, who often have very competitive rates due to lower overhead. Now you might be thinking, won't applying with 5 different lenders destroy my credit score? This is a common and very valid fear, but here's the good news. The credit scoring models are smart. They know you're shopping for a single loan, not trying to open 5 different mortgages. All mortgage-related hard credit inquiries that occur within a specific window, usually 14 to 45 days, depending on the scoring model, are treated as a single event. So do all of your loan shopping within a 2-week period, and the impact on your credit will be minimal. With your lenders chosen, you'll submit your formal application and all those documents you gathered. This is what authorizes them to do a hard pull on your credit. You'll fill out the Uniform Residential Loan Application, which is a standardized, 10-page form that asks for every detail of your financial life. This is the moment of truth. Your application now goes to a mythical creature known as an underwriter. The underwriter is not your friend. They are not your enemy. They are a financial detective whose only job is to assess risk for the bank. They will put your entire application under a microscope. They will verify your employment by calling your boss. They will question every large deposit or withdrawal in your bank statements. They will cross-reference your tax returns with your pay stubs. Their job is to find any reason to say no. Your job is to give them a file so clean, so organized, and so honest that the only possible answer is yes. If the underwriter is satisfied, you'll get the prize, the official pre-approval letter. This letter will state the maximum loan amount you're approved for, the loan type like a 30-year fixed, and often an estimated interest rate, which may be locked for 60 to 90 days. This letter is your ticket to the game. It's what you give to your real estate agent to prove you're ready to play. But be warned, a pre-approval is a fragile thing. It is a conditional offer based on your financial situation at that exact moment in time. If you change that situation, the lender can and will revoke it in a heartbeat. So from the moment you are pre-approved until the moment you have the keys to your new house in your hand, you must enter what's called a financial quiet period. This means you do not make any major purchases. Do not go out and finance a new car to go in your new garage. Do not buy a whole house full of furniture on a credit card. Doing so will increase your debt-to-income ratio and can instantly disqualify you. You also do not change jobs. Lenders value stability above all else. Even if it's a better-paying job, a change introduces a variable, and underwriters hate variables. Don't co-sign a loan for anyone. Don't open new credit cards. Don't even move money around between your accounts without a clear paper trail. Basically, don't breathe too hard on your finances until the deal is done. Getting pre-approved is the true starting line of your home buying journey. It arms you with a realistic budget, makes you a credible buyer, and prepares you for the financial scrutiny to come. It transforms you from a window shopper into a legitimate contender. You've now passed the financial interview. You've got the conditional backing of a bank. You have a letter in your hand that says, "Yes, we trust you with hundreds of thousands of dollars." You have the money approved. Now how do you find the house? And more importantly, how do you assemble the team that will guide you through the maze of open houses, bidding wars, and negotiations? That's where your secret weapon comes in, the real estate agent. And choosing the right one can make all the difference. Think of your real estate agent not as a salesperson, but as your personal guide through a dense, unfamiliar jungle. One guide might know the general direction, but gets you tangled in vines and leads you toward dangerous cliffs. Another guide, the right guide, knows every hidden path, every safe source of water, and can spot a predator from a mile away. Both are guides, but only one gets you to the destination safely and efficiently. That's the power of a great agent. They are your fiduciary, a legal term that means they are bound by law and ethics to act in your absolute best interest. Not their own, not the seller's, but yours. So what does this super guide actually do? It's so much more than unlocking doors and saying, "This is the kitchen." A top-tier agent is a symphony of roles in one person. They are a neighborhood expert, knowing which streets have the best trick-or-treating, and which ones have a surprise train track right behind the fence that the seller conveniently forgot to mention. They are a data analyst pulling comparable sales, the comps, to make sure you don't overpay, and helping you craft an offer that's aggressive but not foolish. They are a master negotiator, the person who will go to bat for you, fighting for a better price, for repairs to be made, or for a closing date that works with your apartment lease. And sometimes they are a part-time therapist, talking you off the ledge when you lose a bidding war on a house you swore was the one. Their job is to manage the entire chaotic process so you can focus on the biggest decision. Is this the right home for you? Finding this person is your first, and arguably most important mission in the home buying process. So where do you find them? The absolute gold standard is a referral from friends, family, or colleagues who recently bought a home in your target area and had a fantastic experience. Don't just ask, "Who was your agent?" Ask the important questions. What did you love about working with them? How was their communication? Did you ever feel pressured? Did you feel like they really fought for you during negotiations? A glowing, specific recommendation is worth its weight in gold because it comes with a built-in layer of trust. If you don't have a personal referral, your next stop is the digital world, but you have to be a savvy consumer. Websites like Zillow, Realtor.com, and Yelp are swimming with agent profiles. Ignore the star ratings at first. A 5-star rating from someone who says, "They were nice," is useless. You want to dive deep into the written reviews. Look for patterns. Do multiple clients mention how responsive they were? Do they talk about the agent's killer negotiation skills that saved them thousands? Do they mention how the agent pointed out flaws in a property they hadn't even noticed? That's the good stuff. Conversely, look for the red flags. Reviews that mention poor communication, feeling rushed, or the agent seeming distracted are huge warning signs. A slightly more unconventional, but highly effective, tactic is to visit open houses in the neighborhoods you're interested in. Don't go to find your dream home just yet. Go to find your dream agent. Watch them in their element. How do they interact with potential buyers? Are they knowledgeable about the house, the neighborhood, the market? Are they just sitting in a corner on their phone? Or are they engaging, professional, and sharp? You can interview multiple agents in a single afternoon without any pressure. Once you have a short list of 2 or 3 candidates, it's time for the formal interview. Yes, an interview. You are hiring someone for one of the largest financial transactions of your life. Treat it with that level of seriousness. Set up a call or a coffee meeting and come prepared with questions. Start with the basics. How long have you been a full-time agent? You want someone who does this for a living, not as a weekend hobby. The market moves too fast for part-timers. Then, get into the specifics of their business. How many clients are you currently working with? A wildly successful agent might be juggling 20 clients, which could mean you won't get the personal attention you need. An agent with 0 clients might be a red flag for a different reason. You're looking for a sweet spot, busy enough to be in demand, but not so busy they can't return your text messages. Ask about their process. What is your communication style, and what can I expect from you? If you're a texter and they only communicate via email once a day, that's a mismatch waiting to happen. Set expectations up front. Then the most important question. In this current market, what's your strategy for helping a buyer like me win a competitive offer? A great agent won't just say, "Offer more money." They'll talk about escalation clauses, appraisal gap coverage, flexible closing dates, and writing a personal letter to the seller. Their answer to this question will reveal their depth of knowledge and strategic thinking more than anything else. And finally, don't be afraid to ask for proof of their success. Can you provide me with the contact information for your last 2 clients? A confident agent will happily provide references. As you're interviewing, you also need to be on the lookout for red flags. If an agent is pushing you to look at homes far outside your pre-approved budget, they might be more interested in a bigger commission than your financial well-being. If they dismiss your concerns or make you feel silly for asking questions, they don't respect you as a client. And the biggest red flag of all, if an agent ever suggests you be anything less than 100% truthful on any document, run. Run fast and don't look back. That's not just bad practice. It's a one-way ticket to mortgage fraud. One final piece of the puzzle is something called a buyer's agency agreement. This is a contract you'll sign with the agent you choose. It formalizes your relationship. It outlines their duties to you, how they get paid, which for buyers is almost always from the seller's proceeds, not out of your pocket, and the duration of the agreement. Read it carefully, but don't be afraid of it. This document is what legally transforms them from a random person showing you houses into your dedicated advocate, your fiduciary. Choosing your agent is like choosing the co-pilot for a transatlantic flight. You need someone with experience, a calm demeanor, and the technical skill to navigate any turbulence that comes your way. Because once you've made that choice, once you've signed that agreement, the real adventure begins. You've assembled your team. You have your lender's pre-approval letter in hand, a financial passport that proves you're a serious contender. You have your agent, your expert guide by your side. Now you're ready to step into the arena. Now begins the most exciting, and sometimes the most heartbreaking part of the entire journey. The hunt. You're about to walk through a dozen different front doors. You'll critique kitchen layouts, measure living rooms with your footsteps, and imagine your life unfolding within those walls. Most will be a no, but then one will be different. One will make your heart beat a little faster. And when you find it, you'll need to be ready to act fast. Because in the world of real estate, you're almost never the only one who thinks a house is perfect. The clock is ticking, and it's time to make an offer. Your agent drafts the official offer, a document known as a purchase agreement. This isn't just a number on a napkin. It's a legally binding contract that outlines every single detail of your proposed transaction. The price is the headline, of course, but the real story is in the fine print. This is where you'll find the contingencies. Think of contingencies as your escape hatches. They are conditions that must be met for the deal to go through. The most common ones are the inspection contingency, the appraisal contingency, and the financing contingency. The inspection contingency gives you a set period, maybe 10 days, to have a professional inspector go through the house with a fine-tooth comb. If they find a cracked foundation or a colony of termites living in the walls, this clause lets you walk away without losing your deposit. The appraisal contingency protects you if the bank's appraiser decides the house isn't worth the price you offered. And the financing contingency says that if, for some reason, your mortgage falls through, you're not forced to buy a house you can't afford. These clauses are your safety net. Along with the offer, you'll submit what's called an earnest money deposit. This is a good faith payment, typically 1 to 3% of the purchase price, that shows the seller you're serious. It's not an extra fee. It gets applied to your down payment at closing. But if you back out of the deal for a reason not covered by your contingencies, you could lose that money. It's your skin in the game. You submit the offer, and then you wait. This might be the most agonizing 24 to 48 hours of the entire process. You refresh your email. You check your phone for text from your agent. Every notification makes your heart jump. The seller could accept your offer as is. They could flat out reject it. Or most commonly, they'll come back with a counteroffer. Maybe they want a higher price or a quicker closing date. Or for you to waive one of the contingencies, which is a risky move you should discuss very carefully with your agent. This is the negotiation dance. You might go back and forth a few times, a delicate balance of numbers and terms, until finally you reach an agreement. Your agent calls with the news. They accept it. For a moment, it's pure euphoria. You did it. You're getting the house. You celebrate, you call your family, you start imagining where your couch will go. But that celebration is just the starting whistle for a 30 to 60-day marathon known as being under contract, or in escrow. This is the period where the real work of the mortgage process happens behind the scenes. The moment the contract is signed, the clock starts ticking on your contingencies. First, you'll officially open escrow. An escrow company, or sometimes a title company or an attorney, acts as a neutral third party. You'll wire them your earnest money deposit, and they'll hold on to it, along with all the important documents, until the deal is officially done. Their job is to make sure everyone plays by the rules, and that the money and the property change hands correctly and legally. Simultaneously, you'll circle back to your loan officer. You send them the signed purchase agreement, and their team kicks into high gear. This is when you need to make a critical decision: locking in your interest rate. A rate lock is a guarantee from the lender that they will honor a specific interest rate for a set period, usually 30, 45, or 60 days. This protects you from market fluctuations. If rates suddenly spike while you're in escrow, it doesn't matter. Yours is locked. The downside: if rates happen to fall, you're stuck with the higher rate. Some people choose to float their rate, hoping it will drop, but it's a gamble. For most buyers, the peace of mind of a rate lock is worth it. Next up, the home inspection. You'll hire a licensed inspector to conduct a top-to-bottom review of the property. They'll climb on the roof, crawl through the attic, check the plumbing, test the electrical outlets, and examine the foundation. They are looking for any and all problems, big or small. A few days later, you'll receive a detailed report, often 50 pages or more, complete with photos and descriptions of every leaky faucet, cracked tile, and outdated electrical panel. This report is your leverage. If it reveals significant issues, you can go back to the seller and renegotiate. You might ask them to fix the problems, or to give you a credit at closing so you can fix them yourself. If the problems are too big and you can't reach an agreement, your inspection contingency allows you to walk away and get your earnest money back. While you're dealing with the inspection, your lender is ordering the appraisal. The appraisal is for the bank, not for you. They need to ensure that the asset they're lending you hundreds of thousands of dollars against is actually worth that much. They send a licensed, third-party appraiser to the property. The appraiser analyzes the home's condition, size, and features, and compares it to recent sales of similar homes in the neighborhood, the comps. This is a huge moment of truth. If the appraisal comes in at or above your offer price, everyone breathes a sigh of relief. But if it comes in low, you have a problem. The bank will only lend you an amount based on the appraised value, not the contract price. If you offered $400,000 but it appraises for $380,000, you have an appraisal gap of $20,000. You now have to either come up with that $20,000 in cash, convince the seller to lower the price, or some combination of the two. If you can't, your appraisal contingency is your ticket out of the deal. As all of this is happening, your loan file is moving to the final stage. Underwriting. If your loan officer was the friendly guide who got you started, the underwriter is the final, unseen boss. They are the person at the bank whose job is to meticulously verify every single piece of information in your application. They are the ultimate risk detector. They will re-verify your employment, re-pull your credit, and scrutinize your bank statements, pay stubs, and tax returns with the microscope. They will source every large deposit, asking for letters of explanation for any transaction that looks unusual. This is why we stressed earlier not to make any major financial changes. Quitting your job, buying a car, or opening new credit cards during this phase can raise a giant red flag and jeopardize your entire loan. The underwriter's job is to give the final stamp of approval. The process can feel invasive and stressful, with requests for documents you thought you already submitted, but it's the last line of defense for the lender. While the underwriter is digging through your finances, the title company is doing its own detective work. They perform a title search, which is a thorough examination of public records to make sure the seller has the legal right to sell the property. They're looking for any hidden claims, liens from unpaid contractors, or outstanding property taxes from previous owners that could cloud the title. Once they confirm the title is clear, they will issue a title insurance policy, which protects both you and the lender from any future claims against the property's ownership. You'll also be required to secure a homeowner's insurance policy and provide proof of that policy to your lender. They need to know that their investment is protected from fire, theft, or other disasters. This entire escrow period is a flurry of emails, phone calls, and paperwork. You're coordinating with your agent, your loan officer, the inspector, the appraiser, and the escrow officer. It feels like you're juggling a dozen fragile glass balls at once. But then, after weeks of anxious waiting and document chasing, you get the email you've been dreaming of. It's from your loan officer, and the subject line might just say, "Congratulations." You open it and 3 magic words jump off the screen: clear to close. The underwriter has given their final approval. The appraisal is good. The title is clear. The insurance is in place. Every condition has been met. The bank is officially ready to fund your loan. The finish line is in sight. All the stress, all the uncertainty, all the paperwork has led to this moment. You are now just a few days away from sitting down at a table, signing a mountain of paper, and being handed the keys to your new home. This is closing day, the final act. You'll walk into a title company or an attorney's office and sit at a long polished table. Across from you will be a closing agent or a settlement agent. Your real estate agent might be there, a reassuring presence. But the star of the show is the stack of documents in front of you, an intimidating tower of paper that represents the single largest financial transaction of your life. Feels surreal, but you're not going to be intimidated because you're prepared. The most important document in that stack is the closing disclosure, or CD. Remember the loan estimate you received at the very beginning? The closing disclosure is its final, legally binding twin. By law, your lender must provide you with the final CD at least 3 business days before you're scheduled to close. This isn't a suggestion. It's a federal rule designed to protect you. It's called the 3-day review period, and it is your golden opportunity to be a financial detective. Your mission is to compare the closing disclosure, line by line, with your most recent loan estimate. Are the numbers the same? Is the interest rate what you locked in? Are the loan terms, the 30-year fixed, the 15-year, whatever you chose, correct? Look at the closing costs. Some fees, like the appraisal fee or credit report fee, should be identical or very close to what was estimated. Other fees, like title insurance, can vary slightly, but there are certain lender fees that cannot increase at all. If you see a major discrepancy, a sudden fee you don't recognize, or a change in your interest rate, you stop everything. You pick up the phone and you call your loan officer immediately. Do not feel pressured to move forward until every single number on that page makes sense to you and matches what you agreed to. This 3-day window is your best chance to catch errors before they become permanent. The most critical number on that entire document is at the bottom of the first page. Cash to close. This is the exact amount of money you need to bring to the table. It's your down payment, plus your closing costs, minus any earnest money deposit you've already paid. This is the final definitive number. Once you've confirmed the closing disclosure is accurate, you'll move on to the other 2 titans of the closing table. First, the promissory note. This document is exactly what it sounds like. It is your promise. It is your IOU to the lender for hundreds of thousands of dollars. It details the total amount you're borrowing, the interest rate, your monthly payment amount, and the dates those payments are due. When you sign this, you are creating the debt. It is a legally binding contract that says, "I will pay this money back." It's simple, direct, and incredibly powerful. Next, you will sign either a mortgage or a deed of trust. The specific document depends on your state, but they serve the same fundamental purpose. This is the security instrument. If the promissory note is the IOU, the mortgage is the collateral. It's the document that links your promise to pay back the loan directly to your new house. It gives the lender a security interest in your property, meaning if you fail to live up to the promise you made in the promissory note, if you stop making payments, this is the document that gives the lender the legal right to foreclose on the home to get their money back. It's the or else clause of the home loan. With the big 3 signed, you'll work your way through the rest of the stack. Disclosures, title documents, affidavits. You will sign your name so many times your hand will cramp. Your signature will start to look like a scribble you did in grade school. But with each signature, you are 1 step closer. Finally, the moment of truth. The cash to close. You won't be bringing a briefcase full of cash. You will provide the funds in one of 2 ways: a cashier's check from your bank or a wire transfer. And this is where I need you to listen very, very carefully. Wire fraud is rampant in real estate transactions. Scammers will create fake emails that look exactly like they're from your title company or attorney, providing you with fraudulent wiring instructions. If you send your life savings to that account, it is gone forever. There is no getting it back. So here is the unbreakable rule. Before you ever initiate a wire transfer, you must verbally confirm the wiring instructions. Call the title company or attorney's office using a phone number you have independently verified, a number from their official website or one your real estate agent gave you weeks ago, not a number from the email itself. Confirm the account numbers over the phone. Do not skip this step. It is the single most important thing you will do on closing day. Once the closing agent has your signed documents and confirmation that your funds have been received, they do their final work. They coordinate with the lender, who releases the loan funds to the seller. This is called funding. Then, the agent officially records the new deed with the county. This is called recording. The moment that deed is recorded, it's official. You are the legal owner of the property. And then it happens. Someone slides a small set of keys across the table. They feel impossibly light in your hand for what they represent. The months of searching, the stress of underwriting, the mountain of paperwork, it all melts away in this one final moment. You did it. You own a home. But the journey isn't truly over. In a few weeks, you'll get your first mortgage statement. Your first payment is usually due on the 1st of the month, about 30 to 45 days after you close. And here's something that catches many new homeowners by surprise. You might not make that payment to the lender who gave you the loan. It is extremely common for lenders to sell the servicing rights to your loan. The company that you pay every month, the one that manages your escrow account and sends you statements, is called your loan servicer. Your original lender might be your servicer, Or they might immediately transfer those duties to a massive servicing company like Wells Fargo, Mr. Cooper, or LoanCare. You will receive a formal notice of servicing transfer in the mail. Do not panic. This is normal. The core terms of your loan, your interest rate, your loan balance, your 30-year term cannot change. The only thing that changes is the name on the check and the website you log into to make a payment. Your loan might be transferred multiple times over its 30-year life. It's just part of the business. Your monthly payment, the PITI, will be automatically drafted or you'll pay it online. The principal and interest portion goes to paying down your loan balance. The tax and insurance portion goes into your escrow account. Twice a year or whenever they're due, your servicer will automatically pay your property tax bill and your homeowner's insurance premium directly from that escrow account on your behalf. Once a year, your servicer will conduct an escrow analysis. They'll look at what they paid for your taxes and insurance last year and project what they'll cost for the next year. If property taxes or insurance premiums went up, which they often do, your escrow account will have a shortage. To cover that shortage and the higher future payments, your servicer will increase your total monthly mortgage payment. Conversely, if they went down, your payment could decrease. This is why your mortgage payment isn't always fixed for 30 years. Even with a fixed-rate loan, the P&I is fixed, but the T&I can and will fluctuate. As you make those payments month after month, year after year, something magical happens. You start building equity. Equity is the portion of the home's value that you truly own. It's the difference between what your home is worth and what you still owe on the loan. You build it in two ways. First, with every single payment, a small piece of the principal is paid down, increasing your ownership stake. Second, as the value of your home hopefully increases over time, your equity grows along with it. This equity is the foundation of wealth creation for most American families. It's a forced savings account that can grow into a substantial asset over time. A mortgage is not just a debt. It's a tool. It's one of the most powerful financial instruments available to the average person. It allows you to leverage a small amount of your own money to control a very large, very valuable asset. It's a path to stability, to putting down roots, to building a life. The process is complex, it is stressful, and it is filled with jargon designed to confuse. But you've made it through this entire explanation. You now understand the language. You know the steps. From pre-approval to closing, from PITI to the CD, you are no longer in the dark. You are an educated, empowered consumer, ready to take on one of life's greatest adventures with confidence. The keys are waiting. Go get them.